Hi, this is Sarah Hobson. I'm the founding partner of Hobson & Hobson PC. We're a divorce and custody firm headquartered in Marietta, Georgia, and we have office locations throughout the metropolitan area. Today I have with me Bill Medley with Quest Rock, a mortgage banker and broker company. Bill is the managing partner, and we're going to be talking about options that you have when you're facing a divorce or you've just gone through a divorce. So Bill, tell me a little bit about who you are, how you got into this industry, and a little bit about your company.
Okay, so many years ago, I got into the mortgage business and I met other people that were also in the business and found that the harder loans, they got it with problems sometimes. The loan officers would shy away from them because they didn't want to hurt their reputation. They didn't want to take the time. There was fear, so they got pushed away. So I started saying, "Hey, let me see those loans, or those transactions." And a lot of them were situations where people had gotten credit scenarios for a multitude. Could be divorce, could be other reasons, and it takes more time. So I started to focus on that, and literally over a period of time, I started getting the majority of my business came from other mortgage companies.
Okay.
Instead of, because they would just refer to me, they said, "He'll take care of it." So it's kind of been many years and over the transactions that you see, but it takes more time. It could be someone who's just got a challenging credit situation. Oh, that loan's too small to fool with, it's not worth my time. And I just had everybody start. Yeah.
Awesome. Yeah, so you're like more of the complex, maybe there's some complex issues or some obstacles, and that's where your company can really shine.
It's where we definitely have made a name for ourselves.
Awesome. We're in a similar niche here. We definitely take on the more complex cases as well, so we definitely have that in common. Really cool. So Bill, why would someone need to refinance during a divorce?
Well, probably the most common thing we see is to pay a settlement that's been reached in a divorce. The other one, somebody wants the house, somebody doesn't want the house, so they need to buy out the equity scenario. Sometimes they can't work it out, they're gonna split and they can't afford the home that they're in because only the two of them, so maybe that's not a refinance situation, but they're gonna be looking to go buy a home on their own, so they have to go through qualifying for a home loan, a brand new home, because either one of them can afford the home without being together.
Right. So. Okay. So like before they may have qualified because the incomes were combined, but separately perhaps that income, the single income of one person would not be enough to get lending.
Correct.
Okay. So what about, what if you're already divorced? What can you do? If the divorce is already finalized, what can you do at that point? If you have, you've separated and you're going to be staying in the home, but your ex-spouse is still on your mortgage.
Okay, so if the ex-spouse is still on the mortgage, and we want to first see that we can qualify them to refinance them off the mortgage. And the reason why we don't just do what's called a quit claim deed and quit claim them off title is it doesn't take them off the mortgage. So if you're the spouse keeping the home or the spouse not keeping the home, you don't want that mortgage follows you. It's your debt regardless, even if someone else is paying it. So by refinancing, it removes the obligation permanently off your credit, and therefore you're not responsible for it. So that's why just doing a quit claim deed alone is not a solution.
Okay, so in that instance, so if you are the person who's not going to be staying in the marital residence and your ex-spouse is remaining in the residence, you definitely don't want that mortgage still attached to your credit, because if they miss a payment, even though you may be court ordered to give them alimony or spousal support to make the payment, if they miss a payment, that is going to affect your credit score. Is that what you're saying?
Absolutely.
Okay. All right, well that is really good to know. Who's best suited for a divorce marital property buyout?
Wow, that's who's best suited. Obviously, if one individual works and has a job and income that can qualify for the mortgage, that would be the first thing you'd have to look at. If the other individual or other spouse cannot qualify, then you kind of answer the question yourself. They wouldn't be able to do the refinance, depending on the size of the mortgage and the scenario. So it really boils down to who's qualified to be able to do that.
Okay. And when you're looking at qualifications, are there some basic numbers to know about like debt to income ratio or credit scores?
Yeah, of course, there's credit's always important. I mean, we have to look at the credit. The from an income is one thing, but here's where we run across in divorce scenarios where the spouse is going to get child support or alimony, and if it hasn't been going on for at least a year, then we can't use it as income. And a lot of people come in where I've had X amount of dollars per month from alimony or child support, and they've just been receiving it through 3 months. They have to be receiving at least a year. There are some cases where it can be 6 months, but pretty much I tell everybody a year. And then we have to have proof that they're receiving it. And I'm kind of getting off the chart, but a lot of times there's cash involved and different trade-offs, and that gets complicated because they traded, I'll pay for the ballet lessons and you give this, and I'm only going to give you this. At the end of the day, it makes it more complicated to make a transaction work unless you can prove that that's what it's for. And during a separation agreement, that can be counted as the history of the income.
So are you looking, is it hitting a tax document in some way, or are you going purely off of bank receipts or?
We're looking at typically bank deposits, receipts. We've seen where we recently saw somewhere where they were using a cash app, and it was coming it was very, very religious in terms of timing, so we were able to document that was the amount, and that it was coming consistently. Most people do some kind of an ACH scenario now.
Mm-hmm. So basically what you're saying is it's important to, if you're hoping to have your alimony payments count towards your income, if you are trying to get financing for a refinance or even perhaps for a new property, you need to make sure that you're not doing trade-offs, that for the alimony award, that you're actually receiving the money, depositing it on time, and that you've got a paper trail so that it can be considered for
and the same thing is true of child support as well.
Okay.
And you do have to have at least 3 years of continuance. So if one child was 16, we wouldn't be able to count the income for that child because they would only be typically till they're 18. So
they would age off at 18 and you wouldn't have the 3
Correct.
years. Okay. All right, well, that's great advice. So how do lenders view, is there a certain debt to income ratio number that people can try to calculate on their own, or do you have any resources on your website for any calculators, or refer any?
Well, we could do all kinds of pre-qualification. I don't like people to try and calculate their own because there's different variables. Nowadays, you can do up to 50% of your gross income. But I never like to get it that close because then you're running into problems. But it's a rough. Most people will find that they're like, wow, I couldn't afford to take 50% of my gross income towards my housing payment or towards whatever other debts I have. That's what most of the time they find out. But then some people have other sources of income we can't count. Like they may make once in a while commissions. They have a part-time job. So to them, I can afford it fine, but we can't use that income.
Right.
That's why we like to be able to look and see exactly where it's from, so they don't assume that they're, that little side job or whatever they're getting counts, but it may not. It probably doesn't.
What happens if you have a stay-at-home, or former stay-at-home spouse who does not work outside of the home, but they are awarded the marital property and the court's ordering them to refinance it? Do you have to have, if you're even looking at considering that as like a settlement option, does that person have to at least have a W-2 job in addition to the alimony, or have you ever seen someone who?
You can do it just off the alimony and just off the child support, but you have to have the 12 months history before we can use it. It has to continue for 3 years from the point of the time we close or the transaction.
Oh wow, okay. That's great to know. What is a Streamline refinance and what are the benefits?
Well, there's a couple of Streamline loans that are a VA loan. There's Streamline, and there's a FHA loan that has a Streamline. The thing is that if there's a spouse on it, the Streamline, which typically is a non-credit qualifying scenario, meaning like you just do the Streamline and not qualify. But when you're removing someone from the loan who was on the loan originally, it becomes a credit qualifying. So you're back to qualifying for the mortgage. The Streamline can be essentially maybe a little less expensive depending on the scenario. There are strict rules to whether you can even use it. And it's not about them, it's about where they're coming from and going to. So if for example, their current rate is 2.5%, they refinanced last year and they're gonna get a divorce now. Well, now rates are 3%, you can't do a streamline and go up in rate.
Okay.
There's just rules about going down. So they would have to do a full credit qualifying refinance.
Okay. If you were able to do the streamline, are there any benefits to it? Is it a faster process or?
It can be. I mean, there's like I said, no appraisals typically, and no income qualifications. But then when you're separating out, if both people were on there for the loan, they're going to make us credit qualified.
Okay. Okay.
But again, no appraisals. That saves them some money there.
What are some tax implications that can come into play when you're looking at a refinance and a divorce?
Wow. My canned comment is they really need to talk to a CPA. We run across it all the time. Obviously, there's potential for capital gains, but that's a large number nowadays. And I tell all my loan officers, if you get asked a question, tell them to consult with their CPA. So.
Good to know. Do you have a CPA that you work closely with that you use regularly?
Mm-hmm.
And so if anyone were to contact you, you could.
Absolutely.
Okay, awesome.
Absolutely.
So Bill, we had been talking about, the interplay between alimony and child support payments when someone is on the receiving end of those payments and trying to get it to qualify as income when looking to refinance. What about the people who are in the position where they're making the alimony payments or making the child support payments? How does that come into play if they're the one who is trying to get a refinance or?
Great question. All right, we definitely run across this from time because it is a part of your debt to income ratios, and sometimes it makes it where it's almost not workable in terms of because the amount of the child support or alimony can be a pretty large number, and it just depends on what their gross income is. And like I said before, once you get to that 50% mark, it's pretty much not going to happen. And that's like I said, it's a great question. And I've seen several times where I've had to say, we can't do anything till it gets down to the last 10 payments, pretty much. If it's alimony and once it's 10 payments remaining or the child support is done, we have to count it. Let's see, it's 10 months for the alimony and the child support too. You can't say, oh, you only have 2 years left. We have to be down to 10 months.
In order to
not count it.
To not include it as the, I guess, a debt. I guess it would go on the.
That's correct.
The debt
It's
portion.
considered just a debt. Exactly.
Okay, wow. So Bill, what about a scenario where we do have a stay-at-home mom? She has been awarded the marital property by the court, but she's not able to qualify on her own. She simply doesn't meet the debt-to-income ratio. Is she able to get a co-signer, like a parent or a sibling or a friend?
She can. It's what's called a non-occupying co-borrower. On a conventional loan, there are limitations. She still would have to qualify to a certain level, and then the co-borrower can make up the difference. However, if it was a government loan, like in an FHA scenario, the co-borrower could virtually qualify for the majority of everything if it's a government loan. And there are loan limitations and so forth that get into that, but that is an option, and we do see that from time to time.
What about if someone gets an award of a lump sum amount of alimony as opposed to payments for a period of years? Do lenders look at that?
You can. There is. If it depends on the age, but we've typically what we're doing now with people over 59 is one thing, but if they're a lot younger and they have the money and it's not in an IRA, so to speak, it's been a lump sum awarded, we put it with a wealth manager and then create a distribution that's monthly, and we do the math to show that that's going to continue on for at least 36 months. It's just there are a little bit of it when they're younger. It's a little bit more. There's some exceptions required, but it is something that can be done.
What about if you have you're receiving alimony, but it's going to be for 2 years or 3 years? Does that matter? Does the length of it matter?
To count it as income, got to have the year that you've been receiving, and then you've got to have 3 more continued beyond that.
So it has to be in the court order that it's going to be at least for 4 years for it to be able to count.
Technically, yes. I mean, you can look at the timing. That almost would still be pretty tight, because the time you start a loan process, and they've got the 12 months, and then they're a couple months into it. Now we're now no longer 36 months. It's almost like if they had 5 years, then yeah, that's
okay. Bill, can you tell us a little bit about what's happened with COVID and the credit scores? What was it before and what is it like today?
absolutely. During COVID, everybody tightened up on credit, because of the forbearances. So some of the credit scoring, whereas before we were doing like this, meaning lower credit that was in rougher shape. With COVID, a lot of people pushed in because it was just that much more likelihood of going into forbearance. So that's why the scoring thing is pretty much, you get down below 620 is like the conventional level. FHA, you can go lower, but it gets pretty rough in terms of financing, in terms of when you get below those scores.
So since COVID, they've tightened that up a little bit, maybe made it a little more.
It's starting to loosen up a little bit. You maybe just think something in terms of where a divorce situation where they maybe thought about credit, and his credit cards have been pushed up, and maybe they're paying the credit cards on top, and now there's a chunk of debt that needs to be paid off. So we can do a consolidation scenario where the cash flow makes sense, where they qualify. They're struggling making the payment now, but then when we take it all into one, then all of a sudden it helps them out. Or if their credit is in a situation where they're not able to get financing, but we'll take it and we'll look and do what's called an example, like what if scenario. What if they did that? What if they paid this down? What if they paid this? What if they did that? And sometimes it's, if you do that for 30 days, your scores will be fine. You need to do this for 6 months, and those are ways, if they follow that, we can get them in a situation where we can help them out.
So it'd probably be smart for them to, as soon as they know that a divorce is on the table, mm-hmm. to go ahead and start talking to a lender, because
yep.
there may be things that are going to take several months to pay down, and you can give them that direction ahead of time. And also, it would be great for the attorneys to know when we are working out, potential settlement agreements, that these are the debts that we need to try to get the other party to pay in order for this person to be right. even for it to be an option for them to be qualified.
Right, and if the court order says that they're going to pay this American Express, this Visa, this, and there's big balances on them, and that person is now paying them, maybe, but it's on the other spouse's credit, it doesn't help us.
Okay.
Because it's still there.
It's still on their credit.
Yeah.
So even if the settlement agreement has a indemnification clause that says that they're going to hold other party, they won't be responsible for this credit card debt, this party's going to hold it. When they go to seek lending, you guys are still looking at that.
It still affects their credit score. It still affects. It's still part of their debt. If we have a situation where we can prove that 12 payments have been made by the other, we're back to the 12 payment proof scenario. We could not count the debt, but it's not easy. You have to go prove where that payment come from. So it's not always that simple when there's a consumer debt involved.
Okay.
The best thing is get it off, get rid of it.
Okay.
Have them go get another credit card, pay that one off, so that it's in one person's name and not both.
Okay, so just have them go open up another one, transfer the debt, get it off of your name, and
whoever's responsible for it to get it so that it's back in one person's name.
Okay.
Well, one thing I was going to add, I wouldn't want somebody just to open to transfer. We should probably look first, because when you do that, you're going to create a credit score movement, and unless they have really great credit, it maybe won't matter. But if they're on the edge and all of a sudden they do this transfer thing and shift balances, it could cause a problem. So we'd rather look and say, what if?
So wait till they talk to you, and
yeah,
you can. Now, when you run their credit, that also impacts their credit score, right? When they're seeking lending.
Well, very, very, very small, and then it's a hard credit pull, and it affects it maybe 5 points and it comes back fairly quickly. It's the model knows that they're looking at a mortgage.
Okay.
So it's not like they're crushed.
Is there a limit that you would say of how many lenders they talk to, or it could add up to something significant?
It does. It's not good to have a bunch of people pulling your credit. You have to, and you have, when you finally do get to it, you're going to have to explain that what were you doing. And so sometimes it depends, like if they're also looking at these personal finance loans and different stuff like that, those can really hurt your credit score.
Okay. So it's better to just kind of talk to you first, get a general sense of what they're going to need to do and
what options they have.
Okay, perfect.
The sooner we can talk to someone, there'll be more options than if they do something and they're like, oh, you probably should have, but then it's too late and you can't undo it.
Right. It's better to be proactive than reactionary and get your advice first as opposed to trying to fix it again.
We could say, hey, if we do it this way, well, this, and maybe both parties are amicable to making this work for each other, but if they make the split and it's gone, it's too late.
Right. That makes sense.
So.
What about equity in the home? How much equity do you need to have in comparison to the loan to even consider a refinance?
You can finance up to 95% of the value, depending on what size mortgage we're talking about. So hopefully that answers your question.
So if let's say you have a jumbo loan and you need to do a refinance, how do you need to have?
It's gonna be more like 90 or less.
Okay.
It's more. In a lot of cases, 80.
80.
When you get into jumbo range.
Okay, that's good to know too. So basically, the way to calculate that is you would look at, what potentially the home would appraise for, and then what's the balance on the mortgage.
Yes. Well.
Or what?
Well, we're going to take all the whatever the new loan we think the new loan amount would be, and then divide that by the appraised value, and then oftentimes. We see in the divorce they've already had an appraisal done. They went out and did it on their own. We have to have to do it. We can't use the one that they had. We have to order it, and it's total random who does these appraisals. Do
they generally line up, or do you see big swings in when people do an appraisal before coming to you?
Depends on how long ago. If it's 6 months recently, you see some property value increases for sure.
Okay. What if the parties, their home is paid off, but they do need to pay out the other person their equitable division of the equity in the home?
So we can cash out up to 80% of the value of a home. So and obviously if we were in a jumbo situation, there are some other rules that come into play, but you can, for most cases, you can cash out up to 80% of a home, and if it's a veteran involved, it can go up to 90%.
Is it generally a similar process as far as getting
same qualifications? Yeah, it's the same scenario.
Okay.
There is if it's a small scenario, like if there's going to be a situation where the home's paid for and there's going to be a $50,000 settlement and there's a $50,000 loan, that gets complicated because of the rules and so forth. So in that situation, we may recommend them to do something different. Go to this particular place to get that loan done.
Okay. What's considered a jumbo loan currently?
A loan amount in excess of $548,250.
Okay, so in excess of $548,250.
Right.
Okay.
Except for one county in Georgia, Oconee County, it's a little higher.
Okay.
Just barely.
Okay, and that's just for the loan amount, not the. So you could buy a $548,000 home and put $100,000 down. Right. That would not be considered a jumbo loan.
Correct.
It's just the amount.
It's just the amount that you're borrowing.
Okay.
Yeah.
Well, Bill, thank you so much for coming here and giving us some great information and some strategy and what people can do when they are looking at possibly having to refinance the marital home, either before, during, or after a divorce. Really appreciate all the insight that you've given us today. Can you let our viewers know how to best get in contact with you?
Great. First, thank you, Sarah, for inviting me. The best and fastest, easiest way is to pick up the phone, give us a call, 678-222-2050, and we'll be glad to help you out.
And you can also find their website at www.questrock.com. That's QUEST rock.com.